Welcome back to Curious Commerce. Today we will discuss about cash flow statements. Majorly, we concentrate on meaning of cash flow statement, activities, and practical business examples. Many businesses earn profit but still fail. Sounds strange, right? Today I am going to tell you why profitable companies shut down and how cash flow statement reveals the truth. If you understand this one concept, you will understand business better than 90% of students. Imagine a shop owner named Ramesh. His income statement shows profit of 5 lakh rupees this year, but still he cannot pay salary, rent, or supplier's bill. Why? What are the reason behind that? Because customers bought on credit. Stock money is blocked in inventory. Bank EMI is due, but no actual cash in hand. Profit is an opinion, cash is reality. That's why we need cash flow statements. So, what is a cash flow statement? Cash flow statement explains where cash comes from, where cash goes, and it shows actual cash position, not accounting profit. Very simple. It tracks only real cash movement, not credit, not based on assumptions, only actual inflow and outflow of the cash considered. You can say this in examination. A cash flow statement is a financial statement that shows inflow and outflow of cash during a period to determine the actual liquidity position of the business. But on Curious Commerce, we understand it practically. So let's break it. Where cash comes from? Cash inflow can be from cash sales, collection from debtors, loan received, capital invested by owners, sales of assets, and interest or dividend received. For example, you can sold goods rupees 10,000 cash. The transaction is cash comes in. You collected rupees 5,000 from customer. It leads to cash comes in, right? You took bank loan of 50,000 rupees. Once again, cash comes in. This is cash inflows. But where cash goes? Cash outflows include purchase of stock, salary payment, rent, electricity bill, loan repayment, buying machinery, and taxes. For example, paid 8,000 rupees as rent, cash goes out, right? Purchased laptop rupees 40,000 rupees. Once again, cash goes out. Paid staff salary of 20,000 rupees. The same thing, cash goes out. Very practical and very real. Let me explain the most important point. Cash flow statement shows actual cash position, not accounting profit. You may sell goods worth 1 lakh rupees today, but customer will pay after 3 months. So, profit shown today, but cash will come later. That's why companies collapse even with profit because they run out of cash, not ideas. Business survives on cash, not on profit. Let me take a small example. Profit rupees 50,000 rupees, but debtors increased rupees 40,000, stock increased by 20,000 rupees. So cash blocked 60,000 rupees. The result, profit but negative cash inflow. That's danger. So remember, profit tells performance, cash flow tells survival. Companies die due to lack of cash, not lack of profit. If you master cash flow statement, you are no longer just a student. You are thinking like a financial manager. Most learners think profit and cash are same, but in real business, they are completely different. Today, let us clearly understand what exactly is cash flow. Cash flow means movement of cash and cash equivalents in a business. Very simple. When cash comes in, we call it as inflow. When cash goes out, we call it as outflow. So, cash flow is all about movement, not profit. It includes cash receipts. Cash receipts mean money coming into business. For example, cash sales, money collected from customers, loan received from bank, capital invested by owners, sale of old furniture or machine. Each of these increases cash balance. You can tell to anybody if cash is entering your hand, it is cash inflow. And the same way, cash payments. Cash payments mean money going out. For example, paying rent, paying salary, paying to stock, electricity bill, loan repayment, and buying equipment. If money leaves your hand, it is outflow. Very easy logic, right? Cash flow is different from profit. This is the most important part. Let's understand with example. You sold goods worth rupees 10,000 today on credit. So in books of accounts, we record profit, right? But no cash received yet. Is there cash flow? Practically no, right? Now another example. You received 5,000 rupees from an old customer. No sales activity takes place today. No profit arises today, but cash increased. So, profit is not equal to cash flow. Profit belongs to books, cash belongs to reality. This is why many profitable companies fail because they do not manage cash flows. Dear learners, you can write it. Cash flow refers to the inflow and outflow of cash and cash equivalents during a period. It differs from profit because it considers only actual cash movement and ignores non cash items. So remember, cash flow means movement of money. It includes receipts and payments. It is completely different from profit. Profit never be equal to the cash. If you understand cash flow, you understand the heartbeat of business. Profit tells how much you earn, but cash flow statement tells whether you can survive. Today, let's clearly understand the meaning of cash flow statement. Cash flow statement is a financial statement, just like profit and loss account and balance sheet. Cash flow statement is also an official part of financial accounts, but its special purpose is different. What does it show? Majorly, it shows two things very clearly: inflow of cash, where money come from, and outflow of cash, where money goes. So instead of asking, did the business make profit? It asks, did the business actually receive and spend cash? That is practical finance. Cash flow statement is prepared for a specific period. For example, cash flow statement for the specific month or for the specific quarter or for the specific financial year, just like profit and loss account. It compares opening cash and closing cash of the period. It is prepared on cash basis. This is the key point. Cash flow statement is prepared on cash basis, not accrual basis. What does it mean? If cash is received, we will record it. If cash is not received, it is not recorded in the books of accounts or in the cash flow statement. If the cash is paid, recorded. If the cash is not paid, it is not recorded, it is not mentioned. For example, you sold goods worth around 20,000 rupees on credit. In books of accounts, recorded as profit, but not shown in cash flow. You received 10,000 rupees from debtor, shown in cash flow, even though sale happened earlier. Cash flow statement ignores promises. It records only the reality. Dear learners, you can write it down. A cash flow statement is a financial statement that shows inflow and outflow of cash and cash equivalents during a specific period prepared on cash basis. This is the perfect answer. So remember, it is a financial statement. It shows cash inflow and outflow. It is prepared for a specific period. It follows cash basis. If you understand this, your foundation of cash flow is strong. Sometimes one sentence can explain an entire financial concept. Now, we will deeply understand the simple but powerful definition of cash flow statement. A cash flow statement shows the inflow and outflow of cash and cash equivalents during a particular period. Let's break the sentence into three parts. It includes inflow, outflow, and a particular period. Inflow means we already know cash coming into the business. Cash outflow means cash going out of the business. Particular period means for the particular month or for the particular quarter or for the particular financial year. It helps us answer how much cash increased or decreased during this period. Not lifetime, not guesswork, only for this specific period. Because this one statement explains it is about real cash, not profit. It focuses on movement of money. It shows business liquidity. It helps in survival decisions. Profit shows success. Cash flow shows the survival. So now you clearly understand and note it down. A cash flow statement shows inflow and outflow of cash and cash equivalents during a particular period. And with this, your foundation and cash flow is strong. Why do companies like startups fail? Why do profitable businesses still struggle? Because they do not understand one thing clearly, that is cash flow. Now we will understand the objective of cash flow statement, not just for exam, but for real business life. If you master these objectives, you are thinking like a financial manager. Cash flow statement is not prepared just for formality. It has clear purposes. There are four major objectives we must understand to know cash generated from operations, to understand investing and financing activities, to assess liquidity position of the firm, to help in planning cash requirements. Let's understand each one with simple logic. To know cash generated from operations, this is the most important objective. Every business runs mainly on its daily operations, like selling goods, providing services, collecting from customers, and paying expenses. The question is the core business generating enough cash? For example, a company shows profit of rupees 5 lakh, but cash from operations rupees 50,000 only. That is a dangerous signal. Why? Because profit may be due to credit sales or from accounting adjustments or from non-cash incomes. But salary, rent, EMI requires real cash, right? A healthy businesses must generate positive cash from operation activities. Operating cash flow shows the true strength of business. The second objective of cash flow statement is to understand investing and financing activity. Cash flow statement also helps us to understand where the company is investing money and how the company is raising money. The investment activities include buying land, buying building, buying machineries, or sell off the assets, investments in shares or any other financial instruments. If company is regularly investing in good assets, leads to a growth mindset. For example, a company buys new machine worth rupees 10 lakh. Cash goes out today, right? But future production increases. This is not loss. This is smart investment. Second part of the second objective is the financing activity. Financing activity include issue of shares, taking loan from the banks, repayment of loan, dividend repayments. This tells us how company is managing its capital, whether it depends heavily on loans, whether it is financially stable or not. For example, if company keeps borrowing every year, leads to risk increases. If company repay loans regularly, leads to financial strength improves. So, cash flow statement gives a complete financial picture of the organization. The third objective of cash flow statement is to assess liquidity position. Liquidity means ability to pay short-term obligations on time. Can the company pay salary, rent, electricity, creditors, bank EMI? If cash balance is weak, leads to even good business will suffer. For example, profit-making company but unable to pay rupees 50,000 salary on time leads to reputation damaged. Employees think that it is not safety place, that's why they leave the organization. The end result is business collapse. So through the cash flow statement, we check is cash increasing or decreasing? Is the business financially comfortable or not? Can it handle emergencies? This is called liquidity assessment. The fourth objective of the cash flow statement is to help in planning cash requirements. This objective is very practical. Cash flow statement helps management answer for the following questions. How much cash will we need next month or for the specific period or for the specific quarter? Can we buy a new machine now or not? Can we afford to hire a new staff or not? Should we take loan or wait for some more time? For example, if cash flow shows low inflow expected, low cash inflow expected next 3 months, then the management will avoid big expenses, delay expansion, and control costs. But if cash inflow is strong, automatically the management think that expansion possible, investment possible, and growth planning possible. So, cash flow statement becomes a planning tool, not just a report. So, remember the four major objectives clearly: to know real cash from operations, to understand investing and financing decisions, to check the liquidity positions, to plan future cash needs. Profit is for books, cash flow is for survival, planning is for success. Two companies show same profit. One grows, one collapses. The difference is not profit. The difference is cash flow. Today, let's understand the importance of cash flow statement. Cash flow statement is important because it helps management in decision making. It is useful for investors and lenders. It shows repayment capacity. It helps avoid cash shortage. Let's understand each one clearly. The first importance is helps management in decision making. Management makes daily financial decisions. Can we buy new machinery or not? Can we hire more staff or not? Can we expand new branch or not? Can we declare dividend or not? All these decisions need cash clarity, not profit clarity. For example, company shows profit rupees 10 lakh, but cash availability only 50,000 rupees. Should it expand? No, right? So cash flow statement guides correct decisions at correct time. The second importance of cash flow statement is useful for investors and lenders. Investors and banks do not trust only profit figures. They ask, if the company generating cash, is the business is stable? Will I get money back? A company with strong positive cash flow attracts investors, banks, and financial institutions because cash flow shows financial health. Third one is shows repayment capacity. This is especially important for loans or for financial assistance. Banks always check, can this company pay EMIs on time? Is cash coming regularly? Is there risk of default? Even if profit is high, if cash inflow is weak, bank will hesitate to give the financial assistance. So cash flow statement shows true repayment capacity. The fourth importance of cash flow statement is helps avoid cash shortage. Cash shortage is the biggest danger in the business. Through cash flow statement, management can predict low cash months, control unnecessary expenses, arrange loan in advance, and improve collections. This helps to avoid salary delay for the employees, missed EMIs, and suppliers complaint and business shutdown. So it does protect the business. So remember, it supports good decisions. It builds trust with investors and banks. It proves repayment ability. It prevents cash crisis. Profit is pride. Cash flow is power. Many businesses show huge profit but still close down. Why? Because they had profit in books but no cash in hands. Now we clearly understand the difference between cash and profit. Profit is an accounting concept. Profit is calculated based on accounting rules. It includes accrual incomes, outstanding expenses, depreciations, provisions, and credit sales. For example, you sold goods worth 50,000 rupees on credit. Profit recorded, right? But cash not received. So profit is influenced by rules and estimates. Cash is real money. Cash means it may be physical cash or the bank balance or the money that can be used immediately. Cash is what you see to pay salary, pay rent, pay EMIs, and buy stocks. Salary cannot be paid with profit. It must be paid with cash. That is reality. Third one is profit includes non-cash items. This is where confusion happens. Profit includes items that do not involve cash at all. Depreciation, no cash goes out, right? Provisions for bad debts, outstanding expenses, prepaid expenses, and accrued income. All these items do not involve cash at all, right? For example, depreciation rupees 20,000, profit reduced by 20,000, but cash is not paid to anyone. So profit is not equal to cash, right? The fourth one is cash flow statement explains the difference. Cash flow statement acts like a bridge between profit and cash. It answers why is profit high but cash low? Why is cash high but profit low? Where did the cash go? From where did cash come? It removes confusions between book profit and actual money. So it becomes a powerful financial tool. So remember this forever. Profit is theory, cash is reality. Profit can mislead, cash flow never lies. If you understand cash versus profit, you understand the business. Your business shows profit of rupees 1 lakh, but your bank balance is only rupees 5,000. Where did the money go? The answer lies in understanding why profit and cash are different. There are five main reasons why profit and cash differ. They are credit sales, depreciation, outstanding expenses, prepaid expenses, and non operating income and expenses. Let's understand each one simply. First one is credit sales. This is the most common reason. You sell goods today, customer promises to pay after 2 months or 3 months. In accounting, sale recorded, right? Automatically profit increases. But in reality, no cash received, no profit rises, but cash does not rise. That's why businesses suffer from cash shortage even with good sales. Second reason is the depreciation. Depreciation is an expense in books, but no cash is actually paid. For example, machine value is rupees 1 lakh, depreciation charged rupees 10,000 per year. Profit reduces by rupees 10,000, but cash remains unchanged. So profit looks lower, but cash is higher. The third reason is outstanding expenses. There are expenses that are recorded but not yet paid. For example, salary expense rupees 20,000 recorded, but salary not paid till next month. It leads to profit decreases, but cash is still with business. Again, profit and cash differs. The fourth one is prepaid expenses. There are expenses paid in advance. For example, Rent paid rupees 20,000 for 3 months in advance. Cash goes out immediately, right? But expense is recorded slowly. So cash decreases, but profit does not decrease fully now. Difference created. The fifth one is non-operating income and expenses. They are not related to main business. For example, profit on sale of land, loss on sale of machinery, interest received, and penalty paid. These affect the profit, but actual cash movement may differ in timing. So again, profit is not equals to cash. So remember clearly, credit sales increase profit, not cash. Depreciation reduces profit, not cash. Outstanding expenses reduce profit, not cash. Prepaid expenses reduce cash, not profit. Non-operating items confuse profit versus cash. Profit is what you see. Profit is what you see. Cash is what you feel. Profit is what you see. Cash is what you feel. Where does a company's cash really move? Daily businesses, buying assets, or taking loans? The answer is inside the three activities of cash flow statement. Today, let us understand the overview clearly. Cash flows are classified into three activities, namely operating activities, investing activities, and financing activities. This classification helps us to understand how and why cash is moving in a business. Operating activities are related to the main business operations. For example, a school collects fees, that is operating inflow. A shop pays rent, that is operating outflow. This shows whether the core business is healthy. A good business must generate positive cash flow from operating activities. The investing activity related to buying and selling long-term assets. This shows whether the company is expanding or shrinking. Third one is financing activities. Financing activities relate to raising and repaying capital. This shows the company's financial structure and stability. So remember this logic. Operating activities means day-to-day business. Investing activities means activities related to assets and growth. Financing activities related to capital and loans. If you understand these three activities, you understand the entire cash flow statement structure. Imagine a business that buys land, takes loans, and sells shares, but cannot generate cash from its main business. Will that business survive? No. That's why operating activities are the heart of cash flow statements. Operating activities refers to the main revenue generating activities of a business. In simple words, these are activities related to the core business work done every day. Without operating activities, there is no real business. Main revenue generating activity means every business has a core purpose. For example, a shop, the core purpose is selling goods. A school's core purpose is to teach. Apart from that, in the point of accounts collecting fees. A hospital treating patient is the core purpose. And the same way, what about the cash flows? A factory, a manufacturing the product, that is the core activity. The cash earned from these main activities is called cash flow from operating activities. This shows the real strength of the business. Related to the day to day business operations, operating activities include daily transactions like cash inflow and cash outflows. Cash inflow includes cash sales, collection from customers, fees received, and service income. On the same way, cash outflow includes payment to suppliers, salary paid, rent paid, electricity bill, internet bill, office expenses, etc. These happen every day, every week, every month. That's why we say operating activity means day to day business operations. Cash flow from core business. This point is extremely important. Operating cash flow tells us, is the main business generating cash? Is the business self sustainable? Or is it surviving only on loans? For example, company A earns the profit of rupees 5 lakh. Operating cash flow is 4.5 lakh. Very healthy business, right? If a company B earns the profit of rupees 5 lakh, operating cash flow is negative 1 lakh. That is dangerous business, right? So always remember, a strong businesses must generate positive cash flow from operation activities. Operating activities are main revenue generation activities. They are related to daily business operations. They show cash flow from core businesses. If operating cash flow is strong, the business has a strong future. If I look at a company's cash flow statement, and see only one section. I will look at operating activities because this section tell me whether the business is truly alive or not. Now, let us understand the examples of operating activity clearly. We already learned operating activities are related to day to day business operations. Now, let us see the most common practical examples. Cash received from customers. This is the most common operating inflow. For example, a shop sells goods, customer pay rupees 20,000 cash. That is cash received from customers. A coaching center collects fees from students of rupees 10,000. That is cash inflow from operating activity. This income from core business activity, so it is shown under operating activities. Money received from customers is the lifeblood of business. Cash paid to suppliers. To sell goods, you must first buy the goods, right? For example, a shop owner pays rupees 50,000 to wholesaler. Or the one more example, a factory pays raw material supplier. This is cash going out for day to day activities of the business. So it is called operating outflow. Without paying suppliers, business cannot run. Third one is payment of wages and salaries. Employees are part of daily operations. For example, paying teacher salary in school, paying staff salary in office, paying wages to the workers of factory. These payments are necessary for running the business every day. So, they are clearly operating activities. If salary is not paid, operations will stop. Fourth one is the payment of operating expenses. Operating expenses are regularly expenses needed to run business. For example, rent, electricity bill, water bill, internet charges, telephone bill, office expenses, advertising expenses. All these are paid for daily functioning of the business. So, they come under operating activities. So remember, money from customers, that is operating inflow. Money paid to suppliers, that is operating outflow. Salary and wages, operating outflows. Daily expenses or the operating outflows. If it happens daily in business, it belongs to operating activities. Dear learners, now we will study the cash flow from operation and activities in two methods, as direct method and indirect method. Now we will discuss one by one. Imagine seeing exactly how much cash comes in and exactly how much cash went out without any confusions. That is the power of the direct method of cash flow statement. Now let us understand its meaning simply. Direct method is a way of preparing cash flow statement where we show the actual cash received and actual cash paid. That means cash collected from customers, cash paid to the suppliers, cash paid for salary, and cash paid for rent. Everything is shown directly in cash terms. That is why it is called the direct method. And direct method shows the actual cash receipts and the payments. This is the biggest feature of the direct method. Under direct method, we clearly show the cash inflows and cash outflows. Cash inflows include cash received from customers, cash received from fees, cash received as commission. Cash outflow includes cash paid to suppliers, cash paid for salary, cash paid for rent, and cash paid for electricity. For example, if business receives rupees 1 lakh from customers and pays rupees 60,000 for expenses, the statement directly shows these two figures. There is no adjustments, no confusions. Dear learners, find this method very easy because it is practical, it matches real life, it looks like a cash book summary, and anyone can understand inflow and outflow easily. Even a shopkeeper with no accounting knowledge can understand direct method. That's how simple it is. But less commonly used method. Even though it is easy, direct method is less commonly used in practice because companies already prepare profit based statements. Because indirect method is easier from accounting records. We discuss later. Accounting standards often encourage indirect methods. So remember clearly, direct method shows actual cash receipts and payments. Direct method is simple and easy to understand, but it is less commonly used in practice. Direct method shows cash as it is, clear, clean, and practical. Most companies in the world do not show actual cash directly. Instead, they start with profit and then discover cash. That approach is called the indirect method. Now let us understand its meaning very simply. What is indirect method? Indirect method is a method of preparing cash flow statement where we start with net profit and then make adjustments to arrive at cash flow from operation activity. So the logic is profit, then we make it as adjustment and we identify the actual cash. That is why it is called indirect. It is not the direct method, it is the indirect method. Under this method, we do not start with cash received. We start with net profit as per profit and loss account. Why? What is the reason? Because companies already prepare profit and loss account. So it becomes convenient to use the same figure and convert profit into cash. For example, net profit of rupees 1 lakh. Now we ask it is equals to cash? Answer is very simple, no. So we adjust it to convert that profit into cash. This is the heart of the indirect method. We should adjust non-cash and non-operating items. We adjust the profit for non-cash items. These affect profit but not cash, like depreciation, provisions for doubtful debts. These are added back because no cash went out. Non-operating items, these are not related to the main business, like profit on sale of asset, loss on sale of machinery, interest received, and dividend received. These are removed from operating profit because they belongs to investing or financing activities. So, an indirect method works like starts with profit, remove fake effects, add back non-cash expenses, adjust with non-business items, and finally reach the real cash. This is the most commonly used method by the big companies, banks. The reason is it matches with accounting records. It is easy to prepare from profit and loss account. And accounting standard prefers this method. So in real corporate world, indirect method is the standard practice. So remember clearly, indirect method start with net profit. It adjusts non-cash and non-operating items. It is the most commonly used method in practice. Direct method shows cash clearly. Indirect method explains why cash is different from profit. Both together make you a complete finance student. In the indirect method of preparing a cash flow statement, we start up with net profit from the profit and loss account. But profit is calculated using accrual accounting, not actual cash movement. So we must adjust profit to convert it into cash profit from operations. This adjustment mainly involve non-cash expenses and non-operating gains and losses. Let us understand each adjustment clearly. The step one is add back non-cash expenses. Some expenses reduce accounting profit but not involve actual cash outflow. Since no cash actually left the business, we add them back. The first one is the depreciation. Depreciation is the reduction in asset value over time. For example, the machine cost is 10 lakh rupees, depreciation charged rupees 1 lakh per year. This rupees 1 lakh reduces profit, but no cash is paid now. Cash was paid when the machine was purchased earlier. So we add depreciation back to profit. Second one is amortization. Is similar to depreciation but applies to intangible assets like patents, copyrights, softwares, or the goodwill. Again, it reduces profit but does not involve cash payment now. So it is added back. The third one is loss on sale of assets. Suppose machine book value is rupees 50,000 rupees, sold for rupees 40,000 rupees. The loss is rupees 10,000. This loss reduces profit, but the actual cash received rupees 40,000 is shown in the investing activities, not operating. To avoid double counting, we add back the loss to operating profit. In step second, subtract the non-operating income. Some income increases accounting profit but are not from core business operations. So we remove them. The first one is profit on sale of asset. For example, asset book value is rupees 50,000, sold for rupees 70,000. The profit is 20,000 rupees. Profit increases the net profit, but this income is related to asset sale, not operations. Cash from sale goes under investing activities, so we subtract the profit from the operating profit. The second one is non-operating incomes. These include income not related to the normal business activities such as interest income, dividend income, profit from investment, and rent received, if not in the main business. These increase profit but are not operating cash flows, so they are subtracted. The simple logic to remember, did cash actually move because of this item? If no cash moved, or if cash belongs to investing or financing activity, adjust the profit. Adjustment summary table. So the adjustment type is the depreciation, the treatment is add back. The reason for that is no cash outflows. Amortization is once again the same thing. It is the add back, that is the treatment for that, and the reason is no cash outflows. It is just like the depreciation. Third one is loss on asset sale. That's add back. The reason is loss already reduced profit. Fourth one is profit on sale, profit on asset sale. It is subtract. The income is not operational, so that's why that is the reason we should subtract it. And non-operating income, once again it is subtracted because not business operations. The final understanding related to the indirect method is accounting profit leads to actual operating cash flow by adding back on non-cash expenses and removing non-operating gains. In the indirect method, after adjusting net profit for non-cash and non-operating items, the next step is to adjust for working capital changes. Working capital means we already know that working capital equals to current asset minus current liability, or the difference between the current asset and current liability we called as in the working capital. These items directly affect cash available for daily business operations. First, we should understand the logic behind that. Did cash get used or did cash come into business? Automatically, working capital changes. That is where cash moved. The second step, the current asset adjustment. The current assets include debtors, what we call as an account receivable, inventory or stock, bills receivable, prepaid expenses, and the short-term assets. Increase in current assets leads to cash decreases. For example, debtors increased from 50,000 to 80,000 rupees. This means more goods sold or credit, or money not yet received, or cash stuck with customers. So, cash decreases. Hence, we subtract increase in current assets. For example, you sold goods but have not collected cash yet. That is the situation. The second scenario is decrease in current assets leads to cash increases. For example, debtors reduced from 80,000 rupees to 50,000 rupees. This means customers paid cash. Cash came into business, so cash increases. Hence, we add decrease in current assets. Step third is current liability adjustments. Current liability include creditors, bills payable, outstanding expenses, and short-term payables. In case increase in current liabilities leads to cash increases. For example, creditor increased from 40,000 rupees to 70,000 rupees. It shows purchase made on credit, or payment not yet made, or cash saved for now. So cash increases. Hence, we add increase in current liability. The last scenario is decrease in current liabilities leads to cash decreases. For example, creditors reduced from 70,000 rupees to 40,000 rupees. This means business paid suppliers or cash went out. So cash decreases. Hence, we subtract decrease in current liabilities. Imagine your home finances. If friends owe your money, cash not in hand, right? You owe money to shopkeepers, you still have cash. So, money struck outside reduces cash. Payment delayed increases cash. Business works the same way. Remember the simple rule: asset increases, cash decreases. Cash decreases, asset increases. Vice versa. When the asset decreases, cash increases. The third scenario is liability increases, cash increases. Liability decreases, cash decreases. So we should concentrate on each current assets and the current liabilities for the adjustment activities. Working capital adjustment shows where cash is blocked, where cash is saved, and actual operating cash available. Investing activities show how a business uses cash to buy or sell long term assets and investments. These activities indicate the future growth plan of the business. In simple words, investing activities show where company invests money for future benefits. But the basic question is, why are they important? Investing activities tell us, is the company expanding? Is it selling assets? Is it investing for future profits? For example, buying machinery means that's the expansion activity, right? Selling land may mean raising cash. So investors understand company growth strategy through this section. Certain examples related to the investment activities. Let us understand common examples. The purchase of machinery. When a company buys machines or equipment, cash goes out. For example, machine purchased for rupees 3 lakh, it leads to cash decreases. This is the cash outflow. The second example is sale of land or building or sale of asset. If a company sells land or building or any asset, cash comes in. For example, land sold for rupees 5 lakh leads to cash increases. This is a cash inflow. The third general example is purchase of long-term investment. If a company buys shares, bonds, or investment for long-term holding, cash is used. For example, investment purchased for rupees 2 lakh leads to cash decreases. The fourth one is sale of investment. If investments are sold, cash comes into business. For example, investment sold for rupees 1,50,000 leads to cash increases. Investing activities deals only with long-term asset, not daily operations. Examples of long-term assets are machinery, land and building, equipment, long-term investment, and vehicles used in business. Let us see a practical case, a company transactions. Purchase of machinery for rupees 3 lakh, old equipment sold for 1 lakh. Net cash used in investing is 2 lakh. It is very simple. The difference between the 3 lakh and 1 lakh. 3 lakh and 1 lakh is 2 lakh rupees is the net cash used in investment. Now we should analyze about this transaction step by step. Purchase of machinery for 3 lakh rupees is the cash outflow, right? So the equipment sale, the old equipment sold, it is for 1 lakh rupees. It means that the cash inflow, is it right? The 1 lakh rupees is the cash inflow. So net investing cash flow is 1 lakh minus 3 lakh is minus 2 lakh rupees. Negative sign means cash used in investing activities. This is the negative. This is the negative 2 lakh rupees. Interpretation of this example. Company invested more money in asset than it received. Business may be expanding or upgrading equipment. So cash is used today for future benefit. Easy logic to remember: buying asset leads to cash goes out. Selling asset leads to cash comes in. Investing activities help us understand company expansion, asset purchase or sale, or long term investing decisions. In a cash flow statement, the final section is financing activity. After understanding operating and investment activities, financing activities explain how the company arranges money and repays money. Financing activities are related to raising capital for business, repaying borrowed funds, providing returns to owners. In simple words, financing activities show how business gets money and how it returns money to investors and lenders. Once again, the basic question may be arise why it is important. Ever a business needs money to start operations or for expand business or for purchase assets or for manage long-term growth for all the reasons. This money comes from the owners or the banks or financial institution. Financing activity shows these funding decisions. Certain examples of financing activities. Let us understand common financing transactions. Issue of shares. When a company issues shares, it receives money from investors. For example, shares issued worth rupees 4,000, cash increases, right? This is cash inflow. So second general example is raising long-term loans. When a company takes loans from bank or any other financial institutions, cash comes into business. The third one is the repayment of loans. When loan amount is repaid, cash goes out of the business. This is cash outflow. The fourth general example is payment of dividend. Dividend is profit paid to shareholders. For example, the dividend of rupees 1 lakh leads to cash decreases. This is also the financing cash outflow. Financing activities deals with owners' funds, borrowed funds, and returns to investors. It does not include daily business expenses. Let us discuss the practical example. Let us calculate the financing cash flow transaction of issue of shares of rupees 4 lakh and loan repayment of rupees 1 lakh 50,000. The step-by-step calculation is cash inflow, the issue of shares. Automatically the company or the business received the money, right? It is 4 lakh rupees. And the repayment of the loan, it is the cash outflow, it is 1 lakh 50,000 rupees. Net financing cash flow is net cash flow equals inflow minus outflow. That is 4 lakh minus 1 lakh 50,000 rupees. That is, the difference is 2 lakh 50,000 rupees. This is positive. The, the meaning of positive cash flow is the cash increases due to financing activities. This means company raised more funds than it repaid. and the business received additional cash support. This cash can be used for expansion or for operations. Easy memory trick for remember: money received leads to cash inflow, money returned leads to cash outflow. Final understanding of this concept: financing activities help us understand how company raises funds, how it repays loans, and how it rewards investors. The complete practical illustration overview: assume company starts the year with opening cash of 1 lakh. The cash from operations or business earn cash through the operations is rupees 2,50,000, that is cash from operations. Company purchases machinery, the investing cash flow, that is negative 1 lakh, it is the cash outflow. That's why I mentioned that negative cash flow. Negative cash flow means generally we use it as called as in the cash outflow. The fourth one is the cash from financing. Company issue shares, financing cash flow of rupees 1,50,000 rupees. Now we should calculate the closing balance, net cash changes in that specified financial year or the accounting year. That is 2,50,000 minus 1 lakh plus 1,50,000 rupees. The net cash changes is 3 lakh rupees. That is 3 lakh rupees positive. It means that it is increase. The closing cash is opening cash plus increase. That is the closing cash is 1 lakh plus the increase is 3 lakh leads to 4 lakh rupees. Final understanding. Cash flow statement shows cash earned from operations, cash invested in assets, cash raised or repaid, and final cash position. Profit shows performance, but cash flow shows survival of the business. To understand the importance of cash flow statement, let us take a simple small shop example. This example helps for learners clearly see why profit and cash are not the same. Just imagine a situation, a small grocery or stationery shop in your area. At the end of the year, the shop owner checks accounts and finds business made profit and sales were good or not. Customers purchase regularly or occasionally. But still the owner faces cash shortage, difficulty paying suppliers, and trouble paying rent or expenses. Now the question is, how can a business have profit but still face cash shortage? The reason is slow customer payments. Many customers buy goods on credit in regular basis. For example, monthly sales of rupees 1 lakh, but customers pay later. Out of rupees 1 lakh sales, rupees 40,000 rupees received in cash, remaining 60,000 rupees still unpaid by customers. But account shows profit because goods were sold, but actual cash received is only 40,000 rupees. Expenses must be paid in cash. Shop owner still needs to pay, like suppliers payment, shop rent, electricity bill, staff salary, and loan installments. These payments require cash immediately, right? But cash is stuck with customers. The end result is profit exists in books, but cash is missing. Role of cash flow statement. This is where cash flow statement becomes important. It explains how much cash actually came into business, where cash was used, and why cash balance is low despite of profit. For example, suppose the profit of rupees 80,000 rupees, but debtor increased by 50,000 rupees and inventory increased by 20,000 rupees. So cash is blocked. Actual cash available becomes much less. Cash flow statement shows these adjustments clearly. On the basis of the above examples, A clear lesson is profit shows earning ability, cash flow shows liquidity and survival ability. A business can survive without profit for some time, but cannot survive without cash. Many small businesses fail not because of losses, but because of cash does not come on time. Payments must still be made. So, cash flow statement helps identify this problem in early stage. Profit is opinion, but cash is reality in business. Let us now understand the importance of cash flow using a manufacturing company example. Manufacturing businesses behave differently from small retail shops because they require heavy investment and longer production cycle. Imagine a situation of a manufacturing company that manufacture furniture. To produce goods, the company needs large factory building, expensive machineries, raw materials, skilled laborers, and storage facility. All these require large cash investment. Manufacturing companies first invest heavily in machines and equipment. For example, machinery purchased of rupees 50 lakh rupees, the factory setup cost is just 20 lakh rupees. This money goes out immediately, so cash decreases heavily in investing activities. But machines will generate income only in future. Cash flow from investing activities at the beginning of operations, cash goes out for purchase of machinery or for factory setup or for equipment installation or for technology purchase or all the above. So investing activities usually show large cash outflows. However, this is not a loss, it is an investment for future profit. Long operating cycle. Manufacturing businesses also have a long operating cycle. Let us see the steps: purchase of raw materials, manufacturing goods, store finished goods, sell goods, and customers pay after some time. This entire process may take 3 to 6 months or more. During this period, cash is already spent, but cash from customers has not yet come. So cash gets blocked in raw materials, work in progress goods, finished goods, and debtors. Suppose a company spends 10 lakh rupees on raw materials, 5 lakh rupees on wages and expenses, but sales cash is received after 3 months. So profit exists in books but cash is not immediately available. Cash flow statement shows this gap clearly. Cash flow statement helps the management for understand how much cash is used in investment, why cash is blocked in operations, when cash will come back to business. It helps companies for plan related to the loan requirements, working capital needs, and expansion decisions. Manufacturing companies may show the high profit, but also cash shortage due to heavy investment and long production cycle. Thus, profit alone does not show real cash condition. Remember, manufacturing businesses need strong cash planning because money goes out long before it come back. Now let us understand cash flow using a service business example. Service businesses are different from manufacturing or trading businesses because they do not produce or sell any physical goods. For example, coaching centers or the education institutions, consultancy firms, IT companies, hospitals, repair service centers, etc. Their cash flow pattern is unique. In service businesses, there is a very little or no inventory. For example, a coaching center or a education institution or a consultancy firm does not need to store goods, right? So, no money is blocked in stock, no warehouse or the storage cost, and very less working capital needed. This is an advantage compared to manufacturing businesses. However, cash flow challenges still exist. Mainly in service businesses depend on human skills and expertise. Therefore, major expenses include staff salary, professional fees, office rent, utility expenses, and software subscription. Among these, salary is usually the biggest expense. Employees must be paid monthly whether customer pay or not. So cash must be available regularly. Service companies usually provide service first and receive payment later. For example, a consultancy firm completes work worth around 2 lakh rupees, but payment is received after 30 or 60 days. During this period, salaries must be paid, office expenses continue, but cash has not yet arrived. The end result is cash shortage may occur. Suppose monthly expenses of a firm, salaries around 3 lakh, office expenses around 50,000 rupees, and total monthly cash needed is 3 lakh 50,000 rupees. But customer delay payments, even though business is profitable, cash is insufficient. Cash flow statement shows this clearly. Cash flow statement helps management to understand whether payment are coming on time, why cash balance is low, need for better billing and collection system. Companies then improve advance payment system, faster billing, and better credit control. Service businesses usually have low inventory, high salary expenses, and cash flow depend on customer payment time. So, timely billing and collections are critical. In service businesses, cash flow is healthy only when customers pay on time. Let us understand cash flow problems using a hospital business example. Hospitals are service organizations, but their cash flow situations is more complex because of insurance payments and high operating expenses. Many hospitals earn good revenue but still face cash flow pressures. The situations of the hospital operational activity. Hospitals provide services like patient treatment, surgeries, emergency services, diagnostic centers, pharmacy services. Patients may pay through direct cash payment or health insurance or the corporate medical insurance schemes or any other government health schemes. Here is where the cash flow issues begins. A large portion of the hospital income comes from the insurance companies. The process usually works like this. Patient receives the treatment first. In second stage, hospital sends claims to insurance companies. In third stage, insurance companies verify the documents. The last stage is the payment is approved and released later. This, the first stage to last stage, process may take 30 to 90 days or even longer. So hospitals has already provided the treatment, but cash is received much later. Revenue appears in accounts, but cash has not yet arrived at. Hospitals have very high operating expenses that must be paid regularly, such as doctor salary, nurse and staff salaries, medical equipment maintenance, medicines and supplies, electricity and utilities, building rent or loan payment, ambulance and emergency services. These expenses must be paid every month, regardless of payment delays. Cash flow stress despite the revenue. For example, monthly hospital revenue is 1 crore rupees, but the insurance payment pending is 60 lakh. Actual cash received is 40 lakh rupees only. The monthly expenses is 70 lakh. The result is hospital earns the profit in accounts, but cash available is less than expenses. So hospital faces cash shortage despite of good revenue. Cash flow statement helps hospital management to understand cash actually received from patients and insurers, cash spent on salaries and operations, why cash balance is low despite of high revenue. This helps the management for to frame the plan related to the working capital loans, faster claim processing, and advance payment policies. Generally, hospitals often face good revenue, high service demand, but cash flow stress due to payment delays. Thus, managing cash flow is critical for hospital survival. In hospitals, treatment happens today, but cash often comes much later, and cash flow management keeps the hospital running. Let us understand the cash flow challenges using a hotel business as example. Hotels often appear profitable, especially during tourist season. However, their cash flow situation is affected by seasonal income and continuous expenses. The general situations in hotel business as follows. Hotels earn income from room booking, restaurant services, events and conferences, and tourism packages. But hotel income is usually seasonal, depending on tourism and travel demand. For example, hill stations earn more in summer, beach hotels are more in winter or holidays, pilgrimage hotels earn during festival season. So, income is not equal throughout the year. During the peak season, rooms are fully booked, restaurant sales increased, events and tourism also increase. Therefore, cash flow becomes high. But during off season, tourist visits gradually reduce, rooms remains empty, revenue falls sharply, cash flow becomes very low. The major challenge is that the hotel expenses do not stop in off season. Hotels must continue paying staff salaries, electricity and maintenance, property rent or loan or EMIs, security and housekeeping costs, equipment maintenance, and marketing expenses. These expenses continue every month even if rooms are empty. For example, peak season monthly income is around 40 lakh rupees. Off season income is rupees 10 lakh, but monthly expenses remain 25 lakhs. The end result is during the peak season cash surplus occurs. During the off season, expenses exceed income, leads to cash shortage or deficit occurs. So even profitable hotels face cash flow stress in slow seasons. Cash flow statements helps hotel management to understand seasonal cash inflows, plan savings during the peak season, manage expenses during off seasons, arrange working capital if needed. Hotels usually save surplus cash earned in peak months to survive off-season periods. Hotel businesses has the certain characteristics. The income is seasonal, but the expenses are continuous. Excess cash in the peak season, cash shortage occurs in the slow season. Therefore, proper cash flow planning is essential in hotel business. Success depends not only on peak season profits but on managing cash during the off season. A cash flow statement is very useful to understand the cash movement in a business. However, like every financial statement, it has certain limitations. Learners must understand that cash flow statement alone cannot show the complete financial position of a company. Let us discuss the main limitations. It ignores non cash transactions. The biggest limitation is that the cash flow statement records only cash transactions. Many important businesses transactions do not involve immediate cash movements. For example, purchase of machinery by issuing shares, conversion of debt into equity, depreciation on assets, asset acquired through credit. So identify these transactions affect the business position but do not appear in the cash flow statement because no cash moves at that moment. So the statement does not show the full picture of the firm related to the financial aspects. Second one is not a substitute for income statement. Cash flow statement does not replace the profit and loss account. Why? What is the reason? Because profit and cash are different. A business may show high cash inflow but still incur losses. A business may show profit but face cash outages. Majorly, income statement shows the profitability, income earned, and expense incurred. But the cash flow statement shows cash movements only. So both statements are required to understand the business performance. The third major limitation is past oriented statement. Cash flow statement shows only past cash movements. It tells what happened last year, how cash moved in the past, but it does not directly predict the future cash flows. Management must still prepare cash budgets and forecast for future planning. So it is a historical information, not future guidance. Cash flow statement is usually for identify the liquidity or the liquidity analysis and the cash management and the inventory decisions. But it cannot alone choose the profitability, long-term financial health, and business efficiency. For complete analysis, we need income statements, balance sheet, and cash flow statement together. Cash flow statement shows cash movement but ignores non-cash items. It cannot replace income statement. It shows only the past data. Cash flow statement shows cash reality, but financial health needs all financial statements together. A cash flow statement is one of the most important financial tools for business management because every business runs on cash. Even profitable companies can fail if they do not manage cash properly. Let us understand the important role of a cash flow statement in a business decisions. The first one is the cash planning. Cash flow statement helps the businesses plan for future cash needs. Management can see how much cash is generated from operations, where cash is spent, whether cash is sufficient for daily expenses. Using past cash flow data, business plan related to salary payments, suppliers payment, operating expenses working capital needs. This prevents sudden cash shortages. The second major rule is the loan repayment planning. Businesses often take loans for expansion or operations. Loan repayment require regular cash payments. Cash flow statement helps managements to check whether enough cash is available. The ability to pay loans on time, need for refinancing or restructuring loans. Proper cash planning prevents default and maintains good credit reputations. The third role is investment decisions. Before purchasing machinery, building, or investment, companies check cash availability. Cash flow statement shows whether business generates surplus cash, ability to invest without disturbing operations, and need for external funding. Companies invest wisely when cash flow is strong. The fourth role is the crisis management. During the difficult situations such as economic slowdown, sales decline, payment delays, pandemic situations, cash becomes most important survival factor. Cash flow statement helps the businesses to control expenses, delay investments, arrange emergency funding, and for maintaining essential operations. Companies with strong cash management survive crisis better. Cash flow statement helps in for planning daily cash needs, for the managing loan repayments, for making investment decisions, for handling business crisis. Profit keeps business growing, but cash keeps business running. Without cash, even profitable companies may collapse. Profit creates success, but cash flow ensures survival of business. Let us conclude our discussions on cash flow statement, an essential financial statement for every business. A business may show good sales and profits in accounts, but if cash is not available at the right time, the business may struggle to pay salaries, suppliers, and the expenses. This is why the cash flow statement is extremely important. It clearly shows how cash enters the business, where cash is used, and whether enough cash is available to run operations smoothly. Many businesses fail not because they lack profit, but because they run out of cash. Proper cash flow management helps business avoid such situations. The biggest lesson for every business owners and students or the learners is profit shows business performance, but cash shows business survival. So always remember, business survive on cash, not just profit. This understanding helps managers make better decisions and ensures long-term business success. Thank you for watching. Please like, share and subscribe to Curious Commerce. Follow our WhatsApp channel Curious Commerce Financial Management Hub for daily finance learning. Thank you all.